Before we start this video, do like and subscribe to our channel and not miss on any updates.
Now we are left with, as far as the standards are concerned, the first one, that is introduction, and then we have the framework, and then we have the applicability. These are not very really of great importance in the examination, but if at all a question comes, it will come for 4 or 5 marks. All right. Now the second thing that you need to do in this particular standard is the study material is slightly bulky. Okay, if you're comfortable with that, you can read through it, but as far as the examination revisions are concerned, our notes are more than sufficient for you to capture the essence of the points given in the study material, and no need to break too much of head in trying to remember these things. That will waste unnecessary time, right? So that is the thing. So moving to the first one, that is introduction to accounting standards. So the reason I suggest students to do this later is there are a lot of things about what are the standards, what do they give, and all of that. Till the time you know what is there in the standard, this introduction doesn't make sense. Okay, that is why we generally do it towards the end. MCQs again can be tested from this particular area because it is a lot more text heavy, right? So when we talk about accounting standards, we have GAP, which is called the generally accepted accounting principle, which are a common set of accepted accounting principles, standards, and procedures that business reporting entity must follow when it prepares and presents its financial statement. So what is GAP? Generally accepted accounting principle. These are common set of accepted accounting principles. So these are accepted principles. These are accepted standards, procedures that a reporting entity must follow when it prepares the financial statement. Okay. Now, accounting standards are a part of your GAP, which are policy documents with respect to accounting transactions or event in the financial statement of entities. So accounting standards are what? Accounting standards are policy documents. They are policy documents with respect to transactions or events in the financial statement of the entities. So they deal with accounting transactions and event regarding recognition of events and transactions, measurement, presentation, and disclosure. So if you see, almost all the standards have this: recognize, measure, present, disclose. Sir, what is recognition? This is when you pass the journal entry in the books, when you record a transaction in the books, when you record an event in the books, that is recognition. Measurement talks about at what amount you should recognize. Presentation talks about how you should present in the financial statements. Simple example could be presentation of current and non-current liabilities. Disclosure is what is the additional information that has to be disclosed or shown in the financial statement or notes to accounts with respect to assets, liabilities, revenue, expenses, and any other item in the financial statement, that is largely equity. So that is what an accounting standard does. Okay. Accounting standard helps to standardize alternative accounting treatments and comparability of financial statements. See, if there are no standards given, each entity would do accounting as per their own wish. Each entity would get their own accounting treatment. Let's say, for example, leases. Somebody may use some other kind of rate, depreciation may not be consistent. All of those problems could be there. So for that, we have accounting standards that helps to standardize the treatment and ensures comparability with the financial statements. As far as accounting standards are concerned, we have seen there are AS1 to AS29. AS1 to AS29, these are the standards. Out of this, accounting standard 6 and accounting standard 8 are no longer applicable. They have been withdrawn. Okay. These we already have seen through. So you'll be able to understand, right? So these are accounting standards. And if it is a listed company, what is applicable is Ind AS, that we'll discuss subsequently. Now, some terminologies that you need to be aware of. One is IFRS. IFRS stands for International Financial Reporting Standards. These are global standards which are accepted or which are implemented in lots of countries across the globe. Okay, that is what is called International Financial Reporting Standards. Then we also have something called as US GAAP. This is specifically for US, generally accepted accounting principles, for US. That is what is called US GAAP. Okay. Now, in India, what happens is you have two sets. One is called Ind AS, another one is AS. Ind AS is IFRS based standard. Ind AS is IFRS based standard, and accounting standards are separate. Accounting standards are not directly based on IFRS. Okay. So Ind AS is a recent addition. Recent means not very recent. Okay, we started implementing these from 2016 onwards. Okay, that is when we started Ind AS. But it is linked to IFRS. We say these are IFRS converged standards. These are IFRS converged standards. So Ind AS are IFRS converged standards issued by the government under the supervision and control of the Accounting Standard Board of ICI in consultation with NAFRA. So finally, National Financial Reporting Authority, they recommend that yes, Ind AS has to be applicable. We will see to which all companies Ind AS are applicable. Accounting standards are applicable to other entities where Ind AS is not applicable. So that also will come to it, right? Now, as far as Ind AS is concerned, globally we have International Accounting Standards Board. We have International Accounting Standard Board. Okay, they are responsible. So International Accounting Standards Committee is responsible for developing international accounting standards. It was established in 1973. It is presently known as International Accounting Standard Board. It is currently known as International Accounting Standard Board. Now, earlier what used to happen is they used to issue something called as International Accounting Standards. Okay, who used to do it? International Accounting Standards Committee. After International Accounting Standards Board took over, they started issuing IFRS. So IAS we have 1 to 41, no need to remember. Okay. IFRS as of today, when we're talking, we have 1 to 17, right? When it comes to Ind AS have been numbered alongside IAS or IFRS. So if it is IAS 1, it is Ind AS 1. If it is IAS 41, it is Ind AS 41. If it is IFRS 1, it is Ind AS 101. If it is IFRS 17, it is Ind AS 117. So like that we follow the Ind AS. Okay. Now, what are IFRS? IFRS are issued by International Accounting Standards Board. International Accounting Standard Boards. These are the standards which are globally taken or globally adopted. Now, some countries, what they do is they directly adopt international financial reporting standards. They directly adopt international financial reporting standards. For example, you go to UK, other European countries, they take it as it is IFRS. The second technique is convergence process. This is used by other countries where the government feels that adopting IFRS as it is not advisable. So let us converge. Converge means what? Take IFRS, add few more items to the IFRS, remove some items from the IFRS, and create a new set of standards. So in India, we have IFRS plus or minus some things that has resulted in Ind AS. So either IFRS or IAS. Whatever we add is called a carve in. Whatever is removed is called carve out. Whatever is added is called carve in. Whatever is removed is called carve out. Okay. So a carve out is a difference from the practices and principles of international standards. International standards say something which we don't follow. All of these you'll understand at final level. So no need to worry about what is there and what is not there. A carve-in is additional guidance given in Ind AS that is not given in IFRS. There are something which is peculiar to Indian economy. There are something peculiar to Indian companies. For that, there are additional guidance available. That is called carve-in. Carve-out, we don't want to follow something in the IFRS. We call it carve-out. We want to follow something extra which is not given in IFRS. That is called carve-in. Okay. So that is the comparison between Ind AS and IFRS. Now, why is there a difference between IFRS and Ind AS? One thing we said, there is carve in and carve out. That is one thing. There are some terminology differences. Like we say statement of P&L, they use statement of comprehensive income. Okay. Then we say balance sheet, they use statement of financial position. So that is one kind of difference. Then some options given in IFRS have been removed in Ind AS. This is not a carve out. So IFRS said 3 ways you can do it. We took only 2 ways. That is not carve out. Then because our economic environment is different. We have removed some accounting treatments and some principles we have changed. That is called carve out. Okay, and no need to spend too much of time in understanding. Just understand there is something carve in, there is something carve out. Removal of option is not a carve out. Now, why did we converge towards global standards? We converge toward global standards so that the Indian financial statements which are prepared, they are comparable with the global financial statements. Also, with the economy booming up, a lot of foreign investment coming into India, foreign investors want financial statements which are IFRS compliant, only then they have this faith on the financial statement. Okay, so for that, what the government thought is, because the economy was opening up and foreign investors were coming up, and then you have this global accounting bodies meet and all of that, hence they thought it is the right time to move towards global standards. Now the need comes because first, we are raising funds from international markets. Companies these days are raising funds from international markets. Each country has different way of preparing financial statements. But if you want to raise money from global markets, then you need to have some common set of financial statements which can be compared. So that is why we move towards international financial reporting standards. Okay. Comparability of financial statements. So international investors and all, they want to compare the financial statements. Now, if India is preparing some other basis financial statements, UK is preparing something else, China is preparing something else, comparability becomes difficult. That is why a common set of accounting principles were considered. This also makes filing with the registrar of companies and similar authorities easier. It ensures uniformity, comparability, transparency, etc. So this is again continuation of comparability part. Uniformity. So because you are following a common set of principles, the way you prepare the financial statements are also uniform. See, if you don't do this, what happens is government may want to twist its financial reporting principles in the way it wants the entity to present the financial statements. So you learn about this, right? Paragraph 46A in Accounting Standard 11. Now here, the government said, okay, we will not take exchange losses to P&L, but we will capitalize, right? Such kind of things are not right if you look at the global financial reporting framework. So that is why IFRS was implemented. And global investment. So because we want global investment to flow in, that is why the convergence is needed. So that is the need for convergence. Remember the side heads and one sentence each, if at all it comes in the examination. What is the benefit now? See, we talked about need. Why did we go? What was the benefit? It improves investor confidence across the world with transparency and comparability. Similar points. Improves inter-unit, inter-firm, inter-industry comparison. Group consolidation will be easy with the same standard by all companies. So just imagine there are multiple different companies following each accounting standard separately. Consolidation will become a nightmare. So with the help of this, consolidation becomes easier. Then acceptability of financial statement by stock exchanges across the globe. So Indian companies, when they want to list in international exchanges, this actually smooths the process. Now, having said all of this, this is theory, a lot of it. There is still one big country, United States, which follows a different set of accounting principles under the name US GAAP. Okay, so they are still following their own way, and the rest of the world is following IFRS. Indian accounting standards are converged standards issued by the government. We have already seen this. The numbering part also we have already disclosed. No need to remember this. Okay, so these are just for your reference. No need to remember this. When it comes to final, you will understand this. Any doubt so far? Any question? Then you could also get a theory question on benefit of accounting standards. Now these accounting standards are your accounting standards which are applied in India. Okay, first, standardization of alternate accounting treatment. This is one of the most important benefit of having an accounting standard. Standardization means each one will follow a standard approach, or that there are only limited options available. For example, if you talk about, let us say, inventory valuation, FIFO weighted average, LIFO is not allowed. So that there is some kind of standardization when there are alternate accounting treatments. So this is the first benefit, standardization of alternate accounting treatment. Okay, then disclosure requirements, additional requirement for disclosures. So for some items, if you don't disclose additional information, it may not give a full picture. For example, leases. Okay, there is an aging analysis which is required, related party disclosures which are required. So these disclosures, if if it was not mandated by the standard, and if it is not mandated by any other law, then it can be missed. So it will help in getting the additional disclosures which are required. Then comparability. You can compare multiple financial statements between different companies year to year basis for the same company. Then reduction in scope of creative accounting. Creative accounting is basically window dressing or manipulating the financial statements. Because you have limited the options that are available, there is a scope in reduction of creative. There is a reduction in scope of creative accounting. All right. So when you get a benefit question in the examination, please remember standardization and comparability. That is there in almost all the points. So standardization, comparability, the two things. Then reduction in scope of window dressing and your additional disclosures if at all required. Then we have, how are the standards set? What is the standard setting process? Okay. Currently, what happens is you have the accounting standard board. You have the accounting standard board. The accounting standard board will frame the accounting standards. They will notify and all of those things. Then NFRA recommends the standards to the MCA, and MCA notifies the standard for the companies. So ICI will frame the standards. They will submit it to NFRA for for the consideration and thing, and then they will recommend standards to the MCA, who will notify. Now, when we talk about the process, first you identify the area in which you need the standard. So the accounting standard board, first thing we need to identify where do we want to set up the accounting standard, or which area requires accounting standard. So that is what is done first. Okay, then we constitute something called as study groups. Study groups means who? These are the groups who will take up the area. They will do research. They will create multiple drafts, and they will have preliminary draft ready, which will be submitted to various other parties as a part of the next step. So first you identify the area. For example, we need a standard on agriculture. So we'll identify, okay, we need agricultural based standard, first thing. After we have done that, we'll prepare a draft and circulate the draft. After that, we'll constitute the study groups. What will the study group do? Study group will prepare the preliminary draft of the accounting standard. Those preliminary draft will be circulated. It will be circulated. Circulated to whom? To the council members of the institute, MCA, SEBI, CAG, CBDT, Standing Conference of Public Enterprises, and all other entities. Okay, that is how they will be circulated. Okay, then you will take the views of all these bodies. Then we will finalize something called as the exposure draft. This is a draft. Now it is an exposure draft. This exposure draft will be given to public. So first, they create a group. They will have a draft. They will circulate amongst the bodies. They will take the views of all the different bodies, and then you will create an exposure draft of the proposed accounting standard. That exposure draft will give it to the public. Then you will receive comments from the exposure on the exposure draft. Then again you will evaluate that and all of those things, and then you will submit it to the council. Then finally, the final draft that is available, it is proposed, and once you take all the viewpoints and all of that, you'll modify the draft, and the final draft you will consider, and that will be finally concluded as issuance of accounting standard. For non-corporate entities, accounting ICI will take care, and for corporate entities, MCA in consultation with NFRA. This is very important from MCQ point of view. For non-corporate entities, ICAI will issue. For corporate entities, MCA will issue in consultation with NAFRA. A small point, again, no need to be too much bothered about this. Implementation roadmap for Ind AS, it is a pretty old roadmap. When did we start? On voluntary basis for any company from 1st of April, or even after that, if company wants to incorporate Ind AS on voluntary basis, it is allowed. From 1st of April on a mandatory basis. From 1st of April on mandatory basis for whom? For companies having net worth of 500 crores or more. Listed, unlisted. companies which are listed, in the process of listing, or unlisted, having net worth of 500 crores or more, or parent, subsidiary, associate, and JV of the above. So, for if Ind AS is applicable to one company, it gets applicable to the parent entity. It also gets applicable to the subsidiary entity, associate, and joint venture of the entities. Okay. So, on mandatory basis from 1st of April, threshold is 500 crores for both listed and unlisted. In phase 2, they cover all listed or in the process of listing companies. If any company which is listed or is in the process of getting listed, you will cover them. But here there is no limit. Here there is no limit. So as of today, if there is any company which is listed or is in the process of listing in any stock exchange in India or outside India, is covered. Okay. But if there is some company on SME exchange, they are exempted. That's the first thing. Then if it is an unlisted company, you need to have 250 crores but less than 500 crores of net worth. So as of today, if you ask me, to which all companies does Ind AS apply? First, all listed companies, all companies in the process of listing, except those listed on SME, unlisted company having net worth of 250 crores or more but less than 500 crores, and parent, subsidiary, associate, and JV of the above entity. Then, very important, once Ind AS is applicable, the entity shall be required to follow Ind AS for all subsequent financial statements. And if Ind AS is not applicable, you will apply accounting standard as per the accounting, as per the notified by the Companies Act. Okay, this part you can leave it. NBF's, it's an advanced version for Ind AS application. This you can just leave it as far as the examination is concerned. Or if you want, you can give one reading. You can give one reading if you want to, but I would not recommend as far as the examination is concerned. For first time, you'll definitely read it. For examination purpose, you can just ignore it.